forms of business organization in the United States. But first, subscribe, hit the bell for notifications, and give a thumbs up. Here's a concise overview of the primary forms of business organization in the United States. 1. Sole proprietorship. 2. Partnership, both general and limited. 3. Corporation, including C Corp and S Corp. 4. Limited liability company, or LLC. 5. Cooperative, forms of business organization in the United States. 1. Sole proprietorship. Definition: a business owned and operated by a single individual. Characteristics: the simplest form of business organization. The owner has complete control. There is no legal distinction between the owner and the business. Advantages: it is easy and inexpensive to form. All profits go to the owner. Simple tax filing using a personal tax return. Disadvantages: unlimited personal liability. Limited ability to raise capital. The business terminates upon the owner's death. 2. Partnership. General partnership. A business owned by 2 or more individuals. Shared management and profits. Each partner is personally liable for business debts. Easy to form. Shared financial burden. Combined expertise. But unlimited liability for all partners, potential conflicts between partners, and the partnership dissolves if a partner leaves. Limited partnership has both general partners with management control and limited partners as investors. Limited partners have limited liability and no management control. At least one general partner with unlimited liability can attract passive investors. Limited liability for limited partners. However, it's more complex to set up, and general partners still have unlimited liability. Corporation. Alright, let's dive into the C Corporation. A C Corporation is a legal entity separate from its owners, who are the shareholders. This structure offers limited liability for shareholders, meaning their personal assets are protected from business debts and liabilities. It's managed by a board of directors and has the ability to issue stock, which can be an effective way to raise capital. Now, let's talk about some of the advantages. Firstly, there's that limited liability protection we mentioned. Secondly, raising capital is easier through stock issuance. And thirdly, a C Corporation enjoys perpetual existence, meaning it continues to exist even if the ownership changes. But, of course, there are some disadvantages. One major downside is double taxation. This means the corporation's profits are taxed at the corporate level, and then shareholders are taxed again on their personal income. Additionally, C Corporations can be more expensive to form and maintain, and they come with more regulations and paperwork. Moving on to the S Corporation. An S Corporation is a special type of corporation that avoids double taxation. This means the profits are passed directly to the shareholders and are only taxed at the personal level. Some key characteristics of an S Corporation include being limited to 100 shareholders and having to be a domestic corporation. Also, it can only have one class of stock. When it comes to advantages, an S Corporation offers pass-through taxation, which can save quite a bit on taxes. Plus, it provides limited liability protection, safeguarding personal assets from business liabilities. However, there are stricter qualification requirements to meet, and there are limitations on ownership. For instance, shareholders must be US citizens or residents, and certain types of trusts and entities cannot be shareholders. Limited Liability Company, or LLC. It's a hybrid structure combining elements of corporations and partnerships. Now, let's talk about its characteristics. An LLC has a flexible management structure and offers limited liability for its members. Moving on to the advantages, LLCs provide limited liability protection and pass-through taxation by default. They also offer flexibility in management and profit distribution. However, there are some disadvantages to consider. Forming an LLC is more complex than setting up a sole proprietorship or partnership. Members are subject to self-employment taxes, and state regulations can vary. Cooperative, a business owned and operated by individuals for their mutual benefit. Let's look at its characteristics. Cooperatives are democratically controlled by their members, and profits and earnings are distributed among them. The advantages of cooperatives include shared costs and risks, democratic control, and potential tax advantages. But there are also disadvantages. The decision-making process can be slower, potential conflicts may arise between members, and there is a limited ability to raise outside capital. Here are some additional insights about cooperatives or co-ops. First, there are various types of co-ops, including worker cooperatives, which are owned and controlled by employees. Consumer cooperatives, owned by customers who use the co-op services. Producer cooperatives, owned by producers of goods or services. Housing cooperatives, owned and managed by residents. And credit unions, which are financial cooperatives owned by members. Co-ops typically operate according to 7 internationally recognized principles: voluntary and open membership, democratic member control, member economic participation, autonomy and independence, education, training and information, cooperation among cooperatives, and concern for community. Cooperatives play a significant role in many economies. For example, there are over 65,000 cooperative businesses in the United States, with a total membership of over 115 million people. Most co-ops use the one-member, one-vote system, regardless of the amount of capital a member has invested. In co-ops, profits, often called surplus, are typically distributed to members based on their use of the co-op services, rather than on capital invested. Some studies suggest that cooperatives can be more resilient during economic downturns than traditional businesses, partly because they focus on long-term stability rather than short-term profits. However, co-ops can face unique challenges, such as slower decision-making processes, difficulty raising capital, and potential conflicts between member interests and business needs. Thank you for watching.